This is Tesla on the monthly chart, and what you can see is you have one head, shoulder. Is this the shoulder or is this the shoulder? That's subjective. But what isn't subjective is the recent decline in the stock from the 280 back just 4 weeks ago to roughly 214. Now we did get a bounce off the daily bias level at $200, which is also where the 200-day moving average hovers just right above that zone. However, fundamentally or sentiment-wise, there's still more downside risk. Shares of EV maker Tesla was hit hard on Friday, down 6%. One of the laggers overall on the broader equity markets. While some macro factors can certainly be pointed to as reasons for today's decline in Tesla and other high growth stocks, Tesla has its own company specific headwind investors are focusing on today. HSBC initiated coverage on Tesla, providing very dim view of the EV player with a sell rating and a $146 price target, which represents roughly another 30% collapse in the stock. HSBC's view on Tesla isn't unique. In fact, 7 analysts have put sell ratings on the stock, with more sell or hold equivalent ratings than buy ratings on Tesla. However, one analyst is bullish. His name is Dan Ives. He is coming from Webb-Bush, and he believes that Tesla prices could rise 50%. He has a target of $310 within the next 6 to 9 months. He believes Tesla is a disruptive technology company and is not just an automotive company. Let's listen into this video.
Clearly, 4 out of 4 of our traders tonight are negative on Tesla, so we had to bring in a pinch hitter here to play the bull. Our next guest has a $310 price target on Tesla. That is nearly 50% upside from here. Let's bring in Wedbush's Dan Ives. Welcome back, Dan.
Yeah, great to be here.
Good to be here. It's great to have you. Should it be kicked out of the Magnificent Seven? Does it go to 50? I mean, like, where do you start?
I mean, I think 6 to 9 months from now, the stock has a 3 in front of it. I think it's back to above 300 as ultimately, I believe this is more of an air pocket that we're seeing from a growth perspective. I think margins start to trough out, and going into next year, I think numbers conservative. And the sum of the parts, as Dan talked about, I think when you look at battery technology, FSD, autonomous, I could argue it's probably one of the best AI plays out there. To me, this is more of a table pounder opportunity rather than time to hide in the cave.
Can it grow? Can it gain market share? Can it achieve scale if China is weak? If there are issues in China? I mean, if Li Auto is really, I mean, it had a very good quarter. It reached 100,000 units. That's the point when Tesla started making it work, 100,000 units. And it's at that critical mark now. So maybe it's poised to sort of, really win the market there.
Yeah, look, you raised great points. Moses, obviously raised great points. I mean, I just got back from Asia. I was there for 2 weeks. I mean, in my opinion, the China story, the cuts they've done, that's the strategic poker move they needed to do. No doubt, demand softened, but I do believe we're starting to see some equilibrium where I look out into next year, you look at 2.3, 2.4 million units, 40, 50% of that needs to come from China. So to your point, no doubt, China is the hearts and lungs of the Tesla growth story. But it goes back to, look, the bears have hated this. If you go back 5 years ago, 3 years ago, and I get it. They view it as an auto company, as Danny talks about. I view it, and have always viewed it as a disruptive technology company, which is why I view the sell-off here and a lot of the hate as more the opportunity to own it, rather than the time that there's some sort of, fire in a crowd theater.
No hate here, all love. But you know what? I think Elon Musk doesn't love the fact that interest rates have been going higher. He made a point of talking about it at length a couple of weeks ago. How important is the bond market to the Tesla bull story? I
mean, look, Musk called it out. And then again, it goes back to, that was a disaster conference call. We talked about that, just the way that was handled. Yeah, of course, it's very important because the price cuts, essentially, nothing even happens to that relative to the consumer. And I think, as Nathan's talked about, ultimately, you need to see that come down. You need to see the China story stabilize. You have a lot of competitors come from all different angles. But if you look at Lucid and others, it's very hard to scale. And I think it just continues to come down. It is still Tesla's world, and everyone else is paying rent in electric vehicles.
So if you look at the gross margin part of the story, where do you think that's going? And what do you think is the right multiple, at least to think about? You say it's a disruptive company on many fronts, but the auto business alone. How do you think about that?
So I think from a gross margin perspective, I think it troughs out over the next quarter or two. I do believe 95% of the price cuts are in the rearview mirror. And I look from an auto, if you actually look at the EV business, I think the EV business is worth $250 to $270 per share. Then you start to look at the sum of the parts, the battery technology, FSD, and what I view as the supercharger now, with them essentially being de facto in the U.S., that's another $30 to $40 per share. That's our view as a disruptive tech company, not